Hey there, macro folks. This is Mr. Hooker, and this is video two for money, banking, and the Federal Reserve System. So this here is the slide we left off on, so we are going to move forward. Here we are. Question: which of these assets would you classify as being the most liquid? Well, if you said A, you would be correct. Monetary role of banks. So only a small portion of M1 is actually currency in circulation. So that cash you got in your wallet is just a small portion of that. And you probably realize that by now. Because, like, how much cash do you really carry? If you're like most people, you're not carrying a whole lot of cash. So bank deposits are the major component of the money supply. And how do we really create money? So I put myself through college working in banks. Um, and so it was fun. If you plan to ever work in accounting, I don't recommend it because it's all backwards from accounting. I'm just going to point that out. But the whole deal with this is money isn't the money you think it is. Money is really those little pink, yellow, green, blue slips that banks run through every time you make a deposit. That's money. So we can take $100 and make it 1,000. Uh, and now it's even crazier than that because there used to be a reserve requirement, and in today's world there is no reserve requirement. So we can take $100 and make it whatever the heck we want to make it. Nowadays, it's even crazier. It's the wild, wild west. Um, so yeah, not trying to freak you out or anything, but like, um, so when you see these things, I've got a whole thing about that in here, but we'll talk about that later. Um, So banks are just financial intermediaries. They use the liquid assets and deposit as deposits. Your money, you go to the bank, you deposit money and finance illiquid investments for borrowers. So somebody wants to go in, borrow money on a car, borrow money for a house. A firm wants to borrow money to buy a new capital for a new capital investment. They want to build a building. They want to buy a machine. We're gonna loan them that money, but that money comes from everybody's accounts. So that's how that works. Um, so banks create liquidity because they don't have to keep all the funds of these highly liquid assets. Not everybody's gonna come in for their money at the same time. And I just have to have the money for the people that are coming in that day. And then, like, most people are going to make their loan payments on time. Just understand, like, most people will make those payments. I got late fees that are going to incentivize them to make their payments on time. And I've got those loan payments spread out through the month. They may not be every day of the month, but I got enough loans that about every 3 days, I'm getting a ton of loan payments. So it's just crazy how that all works. So you do what you got to do. And so small banks are a little bit different. You may not have as many payments coming in. I mean, I was a loan clerk for a little bit, so I had a really weird trajectory. I was a teller for a long, long time. Moved here to the Midwest, Kansas City area, became a loan clerk. Was a loan clerk for a very short period of time and then became a loan officer. Really weird trajectory in a sense. Like you don't typically do that, but whatever. But that's kind of what happened for me. And then after that, I went back to school and then went back to being a teller, a peak time teller. So, because that's what fit my schedule. So, um, that kind of happened. So I saw all these, the way these loans were being run as a loan clerk, like, when they would come in, how many were getting paid, applying the payments and all that stuff to the loan. So for a small bank, for a relatively small bank, corrupt as it may have been. Um, so to meet the depositor's demands, you got to keep currency in its vault. or deposits at the Fed. So the bank reserves are the currency the bank holds in its vaults, plus the deposits at the Fed. You can't just go to the Fed and get your deposits out, though. Like the money for the people is in your vault. Like you can't just say, hey, like if you make an order from the Fed, the soonest that's going to be there is tomorrow. And if you are a distance away, like, here we're in Iowa, we're not really that far away. Minneapolis is our closest one, um, I guess, roughly. There's one in Minneapolis, there's one in Chicago, there's one in St. Louis. Really, we're like not that far from any of them. So, like, really, I don't know that we're that far. So I don't know which one's closest. Maybe St. Louis. If you're in Southeast, St. Louis ain't that far. So you can get your money pretty quickly. Um, it's probably St. Louis. I just got here. Give me a minute on the geography. Probably St. Louis. St. Louis or Chicago. I said Minneapolis, but that's probably way wrong. All right. So what the banks do, um, so basically it's a business, understand that. So we're going to use T accounts, which is a tool for analyzing financial position by showing the business assets and liabilities. This whole thing about a reserve ratio, I'm going to give you my disclaimer on that right now. You need to know it because it's in the book and therefore it's going to be in the materials for the chapter and therefore for the exams. But if you plan to continue in business or economics, forget it as soon as you take the exam because this is not how the world works anymore. There is no longer a reserve requirement and therefore there is no longer a reserve ratio. I've got another slideshow from the Fed out there for you that tells you exactly how this stuff works now. This book is way back, way outdated. This stuff changed in 2008. So the reserve ratio is the fraction of bank deposits that the bank holds as reserves. So if they had $100,000 in deposit and they had reserve, uh, of 10 of they have 100,000 in reserves, they have $1 million in deposit, so they've got a 10% reserve ratio. Um, the Federal Reserve sets minimum reserve ratio for banks, which since March 2020 has been zero. So they say that right there. Um, so to understand why banks are regulated, consider a problem banks can face, and that's bank runs. So, problem of bank runs, banks hold only a fraction of deposits on reserves and use the rest to make loans. So, from time to time, people get worried about banks losing their money. So, if you've ever seen the movie It's a Wonderful Life, great Christmas flick if you've never seen it, highly recommend. There's a bank run in that one. Everybody gets all upset because one of the banks, it's really only like three banks in town. One of them has a bad issue. So everybody wants their money. And like I said, there's not enough money for everybody to get their money. And George Bailey does a great job. James Stewart, George Bailey does a great job of explaining why they don't have everybody's money. Because, hey, your money's in their house, your money's in their house, their money is in their house. So your money's not here, your money's been invested in somebody else's house. So that's basically what it is. Um, so the bank run, the phenomenon which all the banks, depositors try to withdraw their funds because they fear the bank failure. And ironically, they cause a bank failure. So historically, bank runs prove contagious, and that's basically what happens. Um, so as soon as one bank fails, everybody freaks out. They go to their bank, and their bank don't have money either, and so it leads to loss of faith in other banks, causing additional runs. So banks fail in clusters, and they're all like geographically clustered. I think the worst one was somewhere in Texas a number of years ago. It was like 100 and something banks all at the same. all in the same area, geographic area, 100 and something banks in 1 month. Like 160 something, I think it was, in a month. And so, in response to runs, the U.S. established a system of bank regulations that protect depositors. So we have the FDIC. You get $250,000 of your deposit back. So that helps. It really is good. So the four main features we have: the deposit insurance, guaranteed the bank depositors be paid even if the bank can't come up with the funds. FDIC currently guarantees the first 250,000 of each account. There's also a capital requirement, the requirement that the owners of the bank hold substantially more assets than the value of the bank deposits. So that's kind of BS. If everybody remembers that Silicon Valley Bank, right? SVB, that went belly up recently, maybe about a year, 2 years ago. Part of their problem was they were doing some shady investments to try to make money overnight. So they were running overnight repos, overnight reverse repos. And so if the overnight reverse repo, they were thinking like, hey, if the overnight reverse repo is making money, maybe I can do longer term reverse repos, right? So they want reverse repo for 7 days, for 20 days, for 30 days, thinking that they would make more money because typically you do it for one night and the interest rate's extremely low. So they were charging higher interest rates and doing that. And there's absolutely zero risk, by the way, in an overnight reverse repo because it's one night. When you do it for 7 days, 10 days, 20 days, there's risk because weird stuff can happen in those 7, 10, 20 days. What happened? We had insane inflation in that time frame and it devalued their investment. And so their capital was worth less than the money they owed. So they owed, so they owed more than what the investment was than they had in it. And so they were basically underwater in their piece. And so it was just like, yeah, they didn't have the money to buy back. So basically, these overnight reverse repos are loans that you have to buy back, where you have to buy back these securities. Well, the securities had are at the same price. You got to buy it back, and you got to buy it back. And the idea is that you know I'm going to make money on this, and so um, when they do that, that the inflation that happened made the securities worth so much more um, that they couldn't afford to buy them back. And it was just insane how that worked out. So it was just an insane kind of thing. Reserve requirements are rules set by the Fed that determine the minimum reserve ratio for a bank. As mentioned, there is no reserve requirement, it's zero. Discount window almost never used. Arrangement in which the Federal Reserve stands ready to lend money to banks in trouble. As the financial crisis showed us, there are many large financial firms that don't accept deposits, so they aren't covered by deposit insurance or regulation that makes conventional banks safer. So these shadow banks include investment banks, insurance companies, hedge funds, money market fund companies. So how they create money. So if Silas keeps a shoebox full of cash under his bed, deciding to enter the 21st century, deposits the cash at the bank. If the reserve ratio is 10%, we've already said there is no reserve ratio. The bank reserves 10%, lends out 90% of the deposit. So basically, there's no change in the loans. The reserves are up 1,000. Checkable deposits are up 1,000. The loans are up 900. Reserves are minus 900. That's basically what that looks like. So how do we create money? There's an extra $1,000 in circulation. The money supply goes up 1,000. Now, the bank can lend out 900. Somebody else comes in, wants to borrow money, we can loan you 900. Now, but what we're going to do is we're going to tell you to get that 900, you need to open an account. We'll deposit it into the account. You can write checks on it. So now the money supply's up another 900. We're at 1900. Now, it looks like that. We can now loan out another 810, but you need to open an account. We'll put money in the account, do that. Now we're up to 2710. So this will keep going on and on and on. So this is basically what we call the money multiplier. So this is based on what we call excess reserves. So you have required reserves. So there must be excess reserves. Excess reserves are the bank's reserves over and above the reserves required by law or regulation. And assume that banks don't want to hold excess reserves. So the increase in bank deposits from $1,000 in excess reserves is 1,000 plus 1,000 times 1 minus the required reserve plus 1,000 times 1 minus the required reserve to the second times plus 1,000 times the required reserve to the third, so on and so on. So you can simplify it to 1,000 divided by the required reserve. We're going to stop right there and we'll continue this calculation in the next video.